Okay, so we will start quantitative methods today, and the first reading in quant is reading 5, time value of money. A few general points. I think that quantitative methods, and especially this reading, is perhaps the most important reading in the whole curriculum. The reason is that the concepts that we will study here are applied throughout, or at least in many parts of the course. Economics that you studied up till now is obviously important, but it's not, the material that you see doesn't show up over and over. The concepts such as time value of money will show up in corporate finance, it will show up in portfolio management, it will show up in equity, it will show up in fixed income, it will show up in derivatives. So if you don't get this, then it's not possible to pass. So that's why make sure you get this really well. That's one high level remark. In terms of those who are listening online right now, I would suggest that if you don't already have some background in time value of money, then on my website listen to the 2011 time value of money lectures, because in this lecture I'm going to take those concepts and do several examples. And if you are rusty, it's not such a big deal, because as we do these examples from the curriculum, you will become quite good. And I will also assume that you know how to use the calculator. So listen to the calculator tutorial, which again is part of my 2011 lectures. And by the end of, at least in the next few days, you should become experts at using this calculator. During the lecture, have your curriculum open, because all the examples we'll do are from the curriculum. So if you just take notes in the curriculum, I think that will be helpful, and then just have your calculator handy. Okay. Another general remark, I'm going to base this lecture on the curriculum, and the curriculum will give you several formulas. For example, curriculum will give you a formula for present value of an annuity. We are not going to use those formulas. You can actually, the way we will work is we are going to focus on becoming experts with the calculator. The simple analogy, I'll give you this. When you learnt division, you learnt a long division method. Okay, so you learnt how to divide 375 divided by 72. Okay, how many people actually do long division today? The important thing is to understand the concept, and then you do it on a calculator. Okay, if you start doing long division, there is something psychologically wrong with you. Okay, so, and I've had students who insist on using the formula, and they have not been able to pass the exam. So if you start using long-winded formulas, there is no way you can do questions in a minute and a half. So understand the concept and then become an expert at the calculator. The tool is there, so make sure you know how to use it. Okay, so we'll do the curriculum questions, but not in the way the curriculum does them, because the curriculum is a textbook. We just need to become good at answering the questions and understanding the concept. Okay, so quick introduction. What is time value of money? The basic concept is that I'm sure everybody here understands, that you already know that $100 today is obviously more valuable than $100 1 year from today. So that means that there is value in having the money today which exceeds the value of that same amount of money at a later point in time. So that fundamentally means that there is some value to time, and that's what this whole reading is about. In terms of what we'll cover, we'll go with the curriculum flow. Section 2 in the curriculum is basic terminology, the different interpretation of interest rates. Then we'll talk about the future value. So if you have $100 today, how do you figure out how much that's worth in the future? Then the future value of a series of cash flows. If you have multiple cash flows, how do you calculate their future value? Then present value of future cash flows, and then finally solving for rates, number of periods, etc. Okay, so it's not going to be too bad. Let's do section 2 first, which is the different interpretations of interest rates. The first interpretation that you should be aware of is that interest or interest rate is sort of like a discount. The simple way to understand this is the following. Let's say that you buy a government bond today for $900, and the government tells you that after a year they will pay you $1,000. Okay, so you buy something for 900, after a year they pay you 1,000. So what's the so effectively you are buying at a discount of 100. So the 100 is a discount relative to what you will get after a year. What's the interest here? The actual interest amount. So the interest is also equal to 100. Okay, do you get this? So you pay 900 today, you will get 1,000 back 1 year later. So that 100 is a discount. It's also the interest, because in a sense you've lent money to the government and that's the money you will get back. Then, so if that's interest, what's the interest rate? The implied interest rate is 100, which is the interest amount, divided by 900. Okay, so you simply calculate the rate based on the 900 number and the discount. Okay, so discount is, so that's why sometimes you will see interest expressed as a discount rate. Okay, because the rate here is effectively the discount rate. Then the second interpretation is that interest rate is effectively an opportunity cost. What does that mean? That let's say that instead of investing that $900 in a government bond, you spent that $900 on buying a TV, or just spent it somewhere. What was the opportunity foregone? Okay, what you effectively the opportunity foregone is that $100 interest, and again as a rate it would be 900. It would be 100 divided by 900. So interest sometimes is also called the opportunity cost. And then 3, the required rate of return. Interest sometimes is also called a required rate of return, and the way you can think of this is, let's start simple. When you invest in a government bond, then as an investor, when you invest somewhere or put your money somewhere, you are requiring a certain return. If you don't get that return, you will not invest. And at least per finance theory, very simplistically put, when you invest in a risk-free investment, and the classic risk-free investment is a government bond, when you invest in a risk-free investment, the required rate of return R is equal to the real rate that you will get plus expected inflation. So if the real rate that you are requiring is 2% and if expected inflation is 10%, then your required rate of return is 12%. Okay. Now normally if somebody now offers you a 8% return, you will not take it, because if you require at least 2% in real terms, then given inflation of 10%, you will only invest if you get your required return of 12%. Okay, so the thing to memorize here is, when you invest in a risk-free investment such as a government bond, what you require is a real rate plus expected inflation. Now let's go beyond a risk-free investment. Let's say that you now invest in a corporate bond. Okay, so a company such as Engro issues a corporate bond, and let's say that there your required return is 15% as an example. Okay, now how do we come up with that 15%? The required return when you are investing in something that has a risk, again has the same first two components. So there will be the risk-free interest rate, which is, let's say, same 2%. The inflation premium, obviously if there is a 10% inflation, your return should be more than that, otherwise you are effectively losing money. So that's the 10%. Then there is a default risk premium. When you invest in a corporate bond, is there a risk that the corporate bond will default?
Yeah.
So because you are taking that risk, you will demand a certain premium. So let's say that premium is 2%. Okay. Then there is a liquidity premium. What does that mean? When you invest in a corporate bond, are you sure that, let's say 3 months later you want to sell, will you easily be able to sell it at market price? Maybe, maybe not. Okay, so are you taking a risk?
Yes.
You are. In a government bond, typically the market is very liquid and you can sell a government bond easily anytime at market price. But with a corporate bond, especially in Pakistan, the market is very illiquid, which means that you are taking a risk, and the risk of not being able to sell a bond at market price in a short time is effectively the liquidity risk. Because of that liquidity risk, there will be a certain premium. So let's say that premium is 0.5%. Okay, and then the final premium, which you will understand better when you do fixed income, but just to give you a rough sense, let's say there are two bonds that are equal in all respects. One bond is short term, where you let's say it's a 3-month bond, which is a T-bill, versus a 20-year bond. Okay, all else equal. The issuer is the same, so the default risk is the same, the liquidity is the same, the default risk is the same, obviously risk-free rate and inflation are the same. Where do you think you will require a higher return, the 3-month or the 20-year? 20 years. So clearly when you are investing for a longer time or in a longer term instrument, there is a somewhat higher risk, and for that higher risk, when that higher risk because of the longer maturity is called the maturity premium. Let's say that the maturity premium is 0.5. So on this corporate bond, your required rate of return will be the sum of all those numbers, which is 15%. Now to see whether you really understood this or not, we'll do practice problem 1 from the curriculum. Effectively what we are going to do is look at all the curriculum questions. Where there is a good example in the flow of the curriculum, I'll use that example. This particular section in the curriculum does not have an example, so I'll pull something from the back. Okay, but once you've understood all this material, you can then go and do the practice problems in the curriculum. Okay, so you are looking at 5 possible investments here, and creatively labeled investment 1, 2, 3, 4 and 5. Okay, investment 1 has a maturity of 2 years, the liquidity is high, default risk is low, and the interest rate is 2%. So the required rate of return on investment 1 is 2%. On investment 2, the maturity is 2%, liquidity is low, default risk is low, but the required rate is 2.5%. Now the first question for you is, why is the required return on investment 2.5, or why is it more than the required return on 1? Okay, the reason is that this has a lower liquidity. So if the liquidity is low, will investors demand a higher return?
Yes.
Yeah, if the liquidity is low, then investors will demand a higher return, so that makes sense. So what do you think the liquidity premium is?
1.5.
Yeah, so based on the first 2 investments, you can tell that based on these 2, the liquidity premium is 0.5. Okay, then let's move on. So we've essentially done part A. Explain the difference between the interest rate on investment 1 and investment 2. Okay, then investment 3 has a longer maturity of 7 years. Liquidity is low, default risk is low, and the interest rate is not given. Then 4 and 5, you can see the data. What I want you to do now is part B. So estimate the default risk premium. Can you do this? The way you can do this is, let's say that for investment 4, if the only thing we change to investment 4, let's say for a moment that we make this, instead of high liquidity, we make this low liquidity, and you'll see very shortly why I'm doing this. So if the liquidity is low, what will happen to the required return? So will it increase or decrease?
Increase.
Yeah. So all else equal, if suddenly investment 4 becomes less liquid, investors will demand a higher return. How much higher? 0.5, because we've already established from 1 and 2 that the liquidity premium is 0.5. So then what will happen is, if that becomes low, then the required return becomes 4.5. Okay. Now, what are we asked in part B? The default risk premium. If you look at investment 4 and 5, given the slight modification we made to 4, what's the only difference between 4 and 5? The only difference is that the default risk of 5 is higher. Okay, so because of that higher default risk, how much higher return are investors requiring?
2%.
Yeah, so what's the default risk premium?
2%.
So that is 2%. Okay, so that's your default risk premium. Let's see if you can do part C now. Hira?
2.5 and 4.5.
Exactly. So it has to be between 2.5 and 4.5. Why? If you look at investment number 2, so you look at investment 2, so that has, so look at investment 2 and investment 4. Notice that in both 2 and 4, the liquidity is low, just as with 3. The default risk is low. Okay, the only difference between 2 and 4 is the maturity, and 3 again has a maturity between investment 2 and 4. Other than that, investment 3 is like investment 2 and 4. Now, if investment 3's maturity is between 2 and 4, that means that the required return on investment 3 has to be somewhere between 2 and 4, between investment 2 and investment 4. So it has to be somewhere between 2.5 and 4.5. Okay, so this is a good problem that helps you understand the concept we just spoke about. Okay. So now take out your calculators and we will start using them. We are on section 3 now of the curriculum. The first thing that we need to do is calculate the future value of a single cash flow. And with all these time value of money questions, I want you to do them using a timeline. I just think that drawing timelines reduces the probability of making mistakes. Okay, so get very comfortable drawing this timeline. A quick convention about a timeline: whenever you see a 0 or a 1 or a 2, what does this 2 mean? This means the end of period 2. Okay, so it's not the beginning of a period. This is the end of period 2. This is the end of period 3. This is the end of period n. What does 0 mean? The end of period 0, which is now. Okay, so be very clear about that. A timeline always begins at time 0, which is end of 0, which is now. So 1 is end of year 1, 1 year from today. Okay, so that's your basic timeline. Now, example 1 from the curriculum says that you invest $5 million in a CD, certificate of deposit. So that's like locking your money in a bank. Okay, you invest $5 million at 7%. How much will you have after 5 years? The basic formula that you must have studied in college is that the future value after 5 years is equal to the, so future value 5 means how much will the money become after 5 years, is equal to the present value, which is the money you have today. How much money do you have today? 5 million, into the 1 plus the interest rate. So 1 plus R. What's R? 7%. So 1.07 to the power of n. What is n? It is 5. So that's how much money you will have after. So you do the math and you will get this. But on the exam, I don't want you to do it this way. On the exam, what we'll do mostly in today's class, I want you to get very comfortable with this part of your calculator. Okay. So the way we will use this now, when you turn on your calculator, the first thing that you need to do is just do a second and clear TVM. So that means you are cleaning up your time value of money functions. The calculator has a great memory. All the stuff that you might have put in here 1 year ago, when you turn on your calculator, that will still be in the registers. Okay, so always just start by doing a second clear TVM. That clears the register. Okay. Now we are going to plug in these numbers. So the way you plug in these numbers, what is n? It's the number of periods. We are talking about 5 years. So you simply plug in 5. So you set n is equal to 5. How do you do that? Hopefully you've heard the calculator tutorial. So you just type in 5 and then hit n. Then what do? What's the interest rate? Then you plug in 7 and then the interest rate. Then what do? You plug in 5. You can either put in the whole 5 million or just 5 and work in millions. And then you hit PV. And then payment we'll study later. If you have some fixed payment that you are putting in every year, that's the payment. What's the payment here? 0. So you put in 0 for the payment. And then you hit compute and FV. So you should be doing that on your calculators and you will get an answer. Has anybody done this? Plus or minus? Yeah, so you get a minus, and that's important. Why do you get a minus? The way the calculator works is if you put in plus 5, the way you can think of it is in your certificate or deposit, you put money into the bank. So that you can think of as plus, putting money in, and then when you take money out, money is flowing in the other direction, so you will get a different sign. If you want to think in terms of putting money in as negative and money out as positive, then how would you do this? Yeah, in the present value, rather than putting in plus 5, you can put in a minus 5. How do you put in a minus 5? You hit the 5, and then after the 5 you do this plus minus button. Okay, so get comfortable with this. Alright, so that's your basic future value of a present cash flow. Those who are getting bored right now, this will become increasingly more interesting as we move along. If you found this clip interesting and informative, please visit my website www.arifirfanullah.com. Here you will find a tremendous amount of useful material. Right here in the 2011 CFA video lecture series, you will find the entire level 1 curriculum for free, and most of the material here is still relevant. So this is worth looking at. The 2012 video lecture series covers both level 1 and level 2. These lectures are available for a fee. And finally, down here, financial management at IBA. Here you will find my lectures at IBA for a course on financial management. Plus you'll find lots of useful spreadsheets that can help you with financial modeling. So again, please visit www.arifirfanullah.com. Thank you.